we're going to look at some retirement readiness perceptions versus reality, how Canada compares internationally in terms of retirement readiness. So we're going to look at some benchmarking, which is always important to do, to basically evaluate the state of our retirement readiness. Do we need another universal plan or not? Or are there other ways to achieve that? A month ago, we would have been having a totally different conversation than we are today, because that would have been before the federal election. A lot changed with the federal election. I'll touch on that. Then we'll look at the goals of the ORPP and the features, what we do know and what we don't know. And what we don't know, we really don't know. We have to wait and find out. And there's also been some talk of expanding the CPP. So I'll just touch on that for a little bit as well. Okay, at the end, there will be an absolute call to action and what you must do as an organization based on the number of employees that you employ in Ontario. So in terms of readiness perceptions, these are just a couple bullet points. The first one is very broad and general. Media says Canadians aren't saving enough for retirement. Well, how do we quantify that? So I'll provide a survey a couple slides in which attempts to quantify, do we need a universal approach or a more targeted approach? Is there a specific demographic that needs some assistance in order to better save for their retirement? The second bullet point is very clear. I think the days of working for 25 years and being retired for 25 years are gone. We can't possibly live the same lifestyle with only earning 25. We have an infinite amount of income, right? So we can't infinitely only earn 25 years of income to then be able to retire for 25 years. So longevity is tied into there, and I think the expectation, again, we have a finite amount of income. The next one is with regards to the current framework, and it fails to ensure income replacement in retirement. We'll take a peek at that. Another big perception was people change jobs and employers frequently, a statement which I would agree with very readily. And the concern there is that there's less and less pension plans being offered by employers. So what happens if you work in an organization that has a good pension plan and you'd like to change employers? Yes, your money is portable. You can move it wherever you want, but where you land might not have a pension plan, and that's problematic. So the solution, which was divided, basically, is a universal solution right across the board. So the ORPP, I think it's important to also look at a macroeconomic context. So where are we today in terms of our saving capability? And there's a couple macro themes which tie into this. What's the state of the economy? So in 2008, 2009, it wasn't good. But recently, it's been better. So we've been able to increase our net worth through rates of returns of the market, real estate, and public data shows that the Canadian households have over $8 trillion of assets. So if you look at the median of that, every Canadian in theory should have a net worth of about $500,000. We know that's skewed, of course, right up and down. But it does show that there's some net worth ability. There's an ability to grow through real estate in the markets. And GDP growth, if I just touch on that a little bit because it's a real economic term, it's gross domestic product. So it means that we're producing things and we're selling things, and it's the perpetual wheel of money going around. Now, you probably heard a little while ago, we had 2 quarters in a row of negative GDP. That means we're not producing as much as we used to. We're not selling as much as we used to, not collecting as much tax on things as we used to. It's not good for the economy. In economic terms, 2 quarters in a row is actually called a recession. We're programmed to think recession is bad. More concerning for most of the economists out there is deflation. So anybody heard of that word deflation? We know that interest rates are very low right now. So if you have money and you want to invest, you're probably not happy, because if you want a guaranteed investment, rates are very low. If you're looking to renegotiate your mortgage, you're really happy, okay? Deflation, the fear of deflation is when people stop spending because we think we can get a better deal tomorrow. Why would I go out and buy something today when I know it's going to come on sale somewhere within a week, a month? So I'd like to upgrade my TV. Well, they're only getting cheaper. Why don't I wait a month? Why don't I wait for Christmas? That's it, I'll wait for Christmas because it's going to be really cheap at Christmas. No, then I'm going to wait for Boxing Day, then I'm going to wait for the new year for the new version. So the deflation pushes spending out, and that's really bad for the economy because the money's not moving around. Then there's some other concerns, very clear, aging population, and baby boomers are retiring, but we'll note here that they're actually retiring later. Everybody wants to return earlier, but we see that the age is shifting. From 1997, the average age was 61.2, and in 2013, it was 63. So these are some of the macro events, some good and some concerning. If we look at the retirement readiness reality, it's predicated on a study that was done by McKinsey, and they're a big consulting group. I recommend you go to their website if you'd like. The McKinsey Retirement Readiness Index Survey is actually posted there if you'd like to go see it. And essentially, they've determined that 83% of Canadians are currently on track for retirement. How do they draw this conclusion? Sample size very small. They looked at 9,000 households of retirees and people who are working that declared an income on their T4s between $25,000 right up to $250,000. And their survey determined that 83% of the people that are retired are declaring the same income as people who are working. Okay? I don't know if the neighborhood was in the GTA, but that's what they determined. Then they broke it down a little lower and they looked at lower income households and they determined that they're on track 93%. So if you had household income of about $40,000, with the CPP, the old age security, if you're two people, you're essentially, your replacement value is almost 100%. What you get during your retirement is what you got during your working years. So they determined that 93% of that lower income bracket is being taken care of already from a retirement readiness perspective. The next cohort they looked at was the mid to high income households. Mid to high income households, 77% were on track. But if you looked at it a little closer, and I'll get into the definition of the different plan designs in retirement, you either have a defined benefit plan or a defined contribution plan. If you had a defined benefit program and you're part of that cohort, you're 91% ready. So that means we have basically identified the group that needs some assistance. It's mid to high income households that aren't contributing enough to existing pension plans, or they don't have access to pension plans, or they're not saving on their own. So this study is trying to identify if there is a need for a universal program or not, and this is the results of their specific survey. As we know, we are moving forward with a universal solution, but I wanted to present this to you just to stir the creativity a little bit so we could see what, some people think that we're in a very desperate state as Canadians in terms of retirement readiness. It's not that bad. The next slide goes into an international survey which was done. It's a little stale dated like some surveys are. It goes back to 2006. And the source of this one is through the Organization for Economic Cooperation and Development. So this was formed back in 1947 after World War II to try and help the European nations come together and profit economically. Canada and the US joined in 1960, and then Japan and Australia and a few others joined shortly thereafter. The objective here is you want to look at the average income of seniors as a percentage of the overall population. Okay, again, this is driven through, in Canada, it would be a CRA reporting. So how much are the seniors reporting on their income tax versus the working class? Our benchmark is down here, the average. So 82% of seniors in the cohorts which participate are having a replacement value of 82% versus somebody who's working. Canada is doing pretty good up here at 90%. United States is a little lower because of health costs in the States versus our Medicare. So very powerful numbers. Canada's in the top 3 as of 2006. The strength of all 4 pillars, what does that mean? So when we talk about savings, there's different ways of saving, different pillars of generating income while we're retired. The first pillar would be income-driven source that we don't contribute to as a taxpayer. So old age security would be in that pillar, and guaranteed income supplement, which is income tested, so is the old age security. The second one would be the Canadian Pension Plan, which we pay into, and the ORPP will also be in that bucket. Then the third bucket or pillar would be your individual retirement savings or your group savings through work. And pillar number 4 is any non-registered money, including if you own a property or a home, the capital that you have invested in that non-registered asset. So I just want to demonstrate that, again, I want to look at the positive side, glass half full, that in terms of retirement readiness, there might be specific groups which need more nudging than others. And overall, if we compare ourselves in the global space, we're not doing so bad as a country either. In 2000, like I said, that report was done in 2006. Moving forward, there's continued challenges. These are very obvious continued challenges in terms of low workplace pension plan coverage. So we talked about that. The private sector only has 34% coverage right now. DBs are very defined benefit plans are very costly. I'll get into that a little later. And then a lower personal savings. So it's all about disposable income at the end of the day, right? So as the cost of living goes up, we get less disposable income. If we don't have a plan at work, then it comes back onto our shoulders to be responsible and plan for a retirement. And there's a lot of inertia there. So people just aren't saving. So only 16% in 2012 participated in either a group or an individual RSP outside of a planned coverage at work. So that's 50% of the population was saving for their retirement in 2012. The other 50% weren't saving. If we look at unused RSP room, which we all have on our notice of assessment, get our notice of assessment down on the bottom. In Ontario alone, there's $280 billion of unused RSP room. Tax shelter. It's a huge number. Canada is over $700 billion. It's just an amazing number. And then, of course, we look at the longer life expectancy, and that's another trend which is going to continue moving forward, and we're going to have to continue to address that in retirement readiness. So the background on the ORPP, essentially, the main goal was to come up with a plan where employees could save through their employer, disciplined, pre-taxed at a reasonable price. So back in 2014, there was talk around having pooled registered pension plans where they would reach out to the private industry, similar to what Quebec has recently implemented, where the government negotiated with the private industry to set up administration, investment solutions at a reasonable price. So all the administration of the programs was being done by the private industry. It was then decided that they didn't want to dance with the private industry, and they were going to create their own administration, and they were going to be responsible as well for the investment of the assets within the Ontario Registered Pension Plan. Still a lot of unanswered questions on that. Then we got into comparable plans. Up until August 2015, there was no comparable plan other than a defined benefit program. So if you did not participate in a defined benefit program, you're obligated to go into the ORPP. They came out with a definition of a comparable plan, which I'll show on another slide, but it's basically a defined contribution plan with a matching formula. Employer has to put in a minimum of 4%, and the employee has to put in 4%. It has to be 8% into a defined contribution plan. I have a slide with more details on that. But at least they open the door a little bit to giving people solutions to participate in a private plan versus a government plan. If you look from a financial planning perspective, we talk a lot about diversification, usually financial planners and investment people. Right now, the Canadian Pension Plan, you have 10% of your money being invested in the Canadian Pension Plan. 5 or 4.95 from your employer, 4.95 from you. If we add these contributions on top, and again, I'll show you all the details, it's another 3.8. So that's a lot of your savings being administered by one source in terms of an investment. So are you getting a lot of diversification? If all you did was participate in these programs, and I'm not saying whether it's right or wrong, it's just an observation, almost 14% of your money would be administered one way. So they came out with a comparable plan, which gives you the option of also investing and managing some of your own money through the defined contribution plan. And again, I'll get into more technical slides here. Again, the federal election was a big game changer. Originally, the provincial government in Ontario wanted to move forward with an increase in the Canadian pension plan. The federal government, I use the word dance, but federal government kind of just put it off to the side. It wasn't a priority for them at that time. That's when the provincial government said we would like to move forward as a province to create the Ontario Registered Pension Plan. They went back to the federal government at the time and said, we need some help with the administration. Can we leverage off of reporting from CRA? Can we leverage off of some investment, right? Assistance? And the federal government said no. So then they were really in a conundrum, if you wish. Federal election was won by Liberals. As we know, the majority here is Liberal, so it's more cohesive, and that is why they're moving forward with the ORPP, in a nutshell. Okay, so what is the goal? So the goal is basically to offer employees without a comparable workplace pension plan, predictable, reliable, and inflation index stream of income at retirement. So we look at the different features. Benefits for life, so longevity pooling. So what that means is one of the investment risks is if we save and we outlive our money. Okay, so that can happen as individuals. If we invest our own money, we can eventually run out of money. That is to protect from that. If you outlive what their life expectancy number is, you continue to get paid and you win. If you do not live up to the life expectancy, I'll talk to the death benefit, which is similar to the CPP, you do not get all your money back out in terms of for your estate, as an example. Okay? Pooled investment risk, so that's diversification, lots of money going in, able to buy lots of things, things that perhaps an individual investor wouldn't have access to, such as real estate or other more types of alternative investments. Index to inflation is a great thing to have. It will be funded by both employees and employers, and it's locked in. The goal is to replace 15% of an individual's earnings up to $90,000. That is a goal, it's not a promise. We've got to keep that in mind. That's a target. So that means you would have to, in order to maximize your payment in this program, similar to the CPP, you would have to be earning $90,000 for 40 years, and then you'll get 15% of the $90,000. That's basically how that works. It's like the CPP. The CPP has a maximum that you can earn. The average retiree right now is only pulling out half of the maximum because it's predicated on a formula which is all about your earnings. If you're not at the maximum earning threshold, you're not going to get the maximum out of the CPP or the ORPP. Again, not a bad thing, just a fact, okay? So to set proper expectations through retirement. Comparable plans. So I talked about this earlier. The DC RPP, 8% is the total contribution rate that we must put into the program, and at least 50% has to come from the employer. If you have a DB plan with a minimum benefit, the accrual rate, I mean, it's very technical, has to be 0.5%. Most accrual rates, if you want to look at a benchmark, it's usually at 1.5 or 2%. So what the accrual rate is in a defined benefit, you're guaranteed X number of dollars at the end of the day. So there's a formula. It'll be number of years you've worked times a salary, and the salary will be defined as the best 3 years, an average of, or something like that, times this percentage. That's how they come out with a defined benefit calculation. So if you have a defined benefit program and your accrual rate, which a high probability will be over 0.5, you're fine. If we look at the defined contribution and we go out and survey how many people are actually hitting this right now, and I'll show you in another slide as well. This is immediate eligibility for all Ontario employees, so there's no eligibility period. There's probably 10 or 15% of current defined contribution plans that would be considered comparable. All the rest will have to amend either their contribution levels, their eligibility, and a few other things in order to hit this target to be comparable. You can also have a combination DC-DB setup. That's very rare in today's world. And deemed not comparable. If you remember just years ago as HR professionals, we were talking a lot about CAP guidelines, capital accumulation plan guidelines. We were talking about fiduciary responsibilities as a plan sponsor. We were talking about the fact that pension plans no longer had vesting, and if vesting was really important, it's good with the vesting. So if you wanted to be able to say to an employee, you need to be here for 2 years, or else if you leave within the 2 years. So vesting is a way to create loyalty. When that fundamentally changed with the defined contribution plan, DPSPs became very favorable, and that was the trend in the last 5 years. 60-70% of all new plans were RSPs and DPSP set up, not DC. So we see, we were in the DC world, we got away from it, and now as it's defined as a comparable plan, we're finding our way back to it. So DB, I'll just skip over that. I mean, suffice to say, participation is going down. If we look in the private sector in 2011, only 10% had DB plans, about 18% of the private industry employees. So we see that dichotomy. Unions had a big representation in terms of pension plans as well. But from 2010 to 2011, they dropped from 76% to 67%. So a lot of coverage down. It's really hard to DB. This is a big statement here, and this was C.D. Howe and Benefits 2007. They estimated that 1 year of contribution into a DB plan in order to get the benefit at the end of the day equals 33% of the pay. So if you have somebody, do a multiplier, if somebody's working at $50,000, you'd have to fund their DB plan 33% of their salary. So $15,000 a year on top of, so talking total bonus package or structure. So that's how much a defined benefit costs because of the longevity risks. And also markets. Markets go up and down. So for a plan member, so we take off our corporate hats, we're not HR people, we're not employers. What does it mean for me as a member or a person participating or having a choice or wanting to have a conversation with my employer about whether we're moving forward to comply with ORPP or we're going to put a defined contribution plan in play? In terms of the death benefit, it's unknown right now. The assumption would be it'd be similar to the CPP. Okay? In a defined contribution, 100% of the value goes along to your beneficiary. Account value. So if you want to know how much your account is worth with the CPP, there's another statement later, but anyway, we don't know the exact dollar amount until you retire. You're supposed to get a report every 2 to 5 years. So the point is, in terms of transparency and better understanding where we are from a financial planning perspective, right? You can order this off their website if you wanted to. But from a defined contribution, you'll always know where you are because it's calculated on a daily basis. Investment options, it's one size fit all, right? Big melting pot. And under defined contribution, you would have choice and flexibility based on your personal risk tolerance to be able to invest as you choose. Retirement options, so once you finish working, how do you get your money out? Again, we assume this is going to be similar to the CPP. They're going to do a calculation in terms of how much you've put in, life expectancies will be an actuarial calculation, and that's how much they're going to pay you per month. In retirement income options, you'll already know your dollar value, and you can go out and either purchase what we call as an annuity, which will give you a fixed amount every month, similar to the CPP, or a life income fund, which will pay you out a minimum and a maximum of the balance of your portfolio. Reporting, we touched on it. For an individual member within a plan, a defined contribution plan, you'd easily be able to go online to check what your balance is, call a call center, and you'd also receive your statements on a semi-annual basis. Cost. So we don't know a lot. We don't. That's the reality. If we look at the Canadian pension plan is close to $300 billion. Big money. The cost to administer that, the investment board, so the people that administer the investments, it's about $2 billion, and the administration is about $1 billion. So quick math would say it's around 1%, right, to administer the program. But it's a bit of a moving target, and you got to go and get those individual pieces of information. In a defined contribution plan, as we know, there's full transparency, and you would know exactly what the investment management fees and the administration of your program is or are. Potential for an increase in fees. Again, not disclosed, don't know. And here that would be reviewed with your group retirement services provider. So if you have a group plan, Roxana is your agent. She will come to Great West Life and say, Dean, you got to do better for my clients. And it's a negotiated process. And in the group world, we work on an economy of scale. The more people participating in the plan, the more money going in, the lower the investment management fee. Employer contributions. We did see the CPP contributions go up. They were right before 4.95. They were much lower. They've gone up over the years. Over here, we know it's predictable. It's predictably high at 8%. But it could go up more if you want. But from a budgeting perspective, there might be a bit of an advantage there. Portability. This is a big question mark. Right now, it stands. What happens if you live in Ontario today, you accumulate in the ORPP, and then you move to Alberta? It hasn't yet been defined what's going to happen there with the ORPP. Do you leave it behind? I mean, it's still your money. It's invested in your name. It will continue to be invested. But in terms of consolidating assets at one point, payouts, how does that all work? We don't know. And of course, in a defined contribution plan, it's portable to your new employer. It's portable to the bank, a fund company, or an agent of record. So what does this all mean to me? There's going to be a phased-in strategy up here in 2016, and I don't know when. Nobody knows when yet. Each organization in Ontario will be contacted, and they will ask you whether you have a comparable plan in place or not. And if you do not, there is a schedule of when you need to start participating in the ORPP, or scramble out to find somebody like Roxana that can line you up with a service provider to set up a defined contribution plan at the pre-established rates. If you already have a registered pension plan, but you do not have the same contributions that are required, 4 and 4, or an immediate eligibility, which is now required, you fall into wave 4. You're going to be given a little bit of leeway here, and you're only going to have to start enrolling people in 2019. So again, if you have a registered pension plan, but you're not making the contributions that we saw earlier, or everybody is not eligible to participate, or it's not immediate eligibility, you have until then to get everybody on board. If you have a pension plan which meets the eligibility with a 4 and 4 match, but you have some people not participating, because you can have a non-mandatory program, you will have until 2019 to enroll everybody on the program, because it will be mandatory for everybody. And statistically, what we see as a service provider is even if an organization has a registered pension plan in place, even though there's an employee and employer match, there's still money left on the table by employees. There's only about a 75% participation rate on average. So there's, rough figures, 25% of the people are going to have to jump in here in 2019. So wave 1 is 500 employers and more. I think we need to talk about that too much. Wave 2 is 50 to 100, which you can easily obtain. So we are now obligated to enroll 2017, and in 2018 it's phased in. So your contribution rates will be 0.8 of 1% employer, 0.8 employee for 1.6, slowly building up to the mandatory 3.8 over the 3 years. If we're in 50 or fewer employees, here's our schedule. 2018, the same graduated thresholds, and wave 4 we addressed. So that's the nuts and bolts in terms of phasing in. Employers need to be aware, be equipped, talk to their financial advisors, go through scenarios, and discuss what's best for my organization's unique needs, what's best for my employees' unique needs. Let's have a conversation. So ORPP details, mandatory, immediate eligibility, full-time and part-time. Don't know the definition yet of the part-time. Contribute from 18 years old right up to 70. Self-employed, I reviewed with you. So if you draw a salary, you will have to comply. If you do not draw a salary, then you're okay. Aims to replace the 15%. Benefit payments start in 2022 and indexed for inflation. Some of, or more things we don't know. Minimum income level for employees. So with CPP, we have the maximum. There's also a minimum of $3,500. We assume that they'll go along the same lines. Don't know yet. Lower income earners. So there was that study which said the lower income earners were just fine in terms of replacement income. We don't know enough to be able to run back testing or testing, if you wish, to see if there'll be clawbacks by adding another layer of government income on the old age security or the GIS. But our gut instinct is yes. So we'll be paying into it, but the lower income earners will then essentially get clawed back on some of the other benefits, being the OAS or the GIS. But I can't say that with certainty right now. Payment levels for early retirees. So what happens if it's implemented in 2018 and I leave in 2020? Well, you're not going to get paid to 2022 from what we understand today. And what are you going to get back out? Don't know, because you've only been in 4 years and there's all the actuarial calculations. So if you go in, and if you follow the demographics, this is the baby boomers, right? So baby boomers are right at the cusp here about going in and coming right out. And we don't know enough information yet. We haven't been provided enough information yet as an industry. So I'm sorry I can't answer those questions, because I'm sure everybody's thinking it. Again, if you move away from Ontario, financial planning. So as an industry, we have financial planning tools. You know, if you have so much in your RSP and you have so much personally at a rate of return, you should have this much at retirement and through retirement. We're going to have to factor in the ORPP to our calculators. We're not there yet. We need to better understand it. Impact on personal savings. We talked about disposable income. If you now have to put another 2%, rounding it off, 2% into ORPP, or if you don't currently have to participate in a defined contribution plan, you have to put 4% in there, that's going to impact your disposable income as well as your personal potential savings. Kathleen Wynne, with regards to the CPP, and she made reference, because before the election she said if the Liberals get in, we might just go this route, right? Increase CPP for everybody for ease of administration. Once they got in, she realized the timelines are a bit longer than So she basically just wrote, and I'll quote, "We are going to continue to implement the ORPP until we know that there is a plan to enhance the CPP that will deal with the issues of the majority of the people in the province not having a workplace pension plan and the adequacy of their retirement security." So they're moving forward. And I'll close on that. And there's a website which has lots of information. You can call the 1-800 number. You can get a concierge if you want to type in your query, and they'll get right back to you. So I thank you for your time.